Good morning, good afternoon, good evening. Welcome to the Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. Today, we are talking about the ins and outs of tax loss harvesting. So if you want to learn about that, stick around. If you don't do it. Go away. But anyway, before we start talking about this, you have to earn the content. To earn that content, it's easy. You like, you comment, you subscribe, you follow, whichever platform you're on, whether it's YouTube or your podcast player. But if you could do that, that'd be great. That enables us to enhance our reach and reach more people, just like we reached you. We are a financial services podcast. So with that being said, we do have a disclaimer. Gentleman named Jordan sounds a lot better than me doing it. So Jordan, take it away.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
Jordan's done. That was the best disclaimer you've ever heard. So before we go through our podcast, it's split into 4 sections. You get to know us professionally and personally. We dive into content and then we answer questions. So our first section is called You Good? So, Heather, you good?
I'm great. I just finished this book, Buy Back Your Time.
Mhm.
Such a fantastic book. I feel like I have not had, there's not many tools, resources on how to be a great boss, be a great leader, how to manage a assistant or a client service specialist, like how to hire. There's a lot of resources on, right? But
Mhm.
I think how to manage someone and how to motivate someone, that's a really important skill because turnover is one of the most expensive things in a company. And this book, I am so glad I took the time and read it. It gave me like an agenda to even walk through in our sync meetings. I came up with an ideal calendar for a week of okay, I need to batch client meetings so I can be really efficient when I'm in that zone. Like just really how to manage my time, how to really help Lisa thrive, how to delegate, how to teach her. So in this book, this author explained doing these playbooks where you kind of record yourself doing things. And so that gosh, I hope she doesn't, but if she ever leaves, it's like in comes whoever the new Lisa is. And there's all these Google Docs that can just, that we've been reiterating, teaching how to do things.
That's cool. Yeah, there's a lot of people that read those books and then just put it back on the bookshelf and don't do anything with it.
Yeah.
I like those books that give you the action steps and they're easy to take.
Yeah. And actually do them. I mean, so I even starred and underlined. I'm one that still has to read books.
Awesome.
Yeah.
I'm good.
All right. How you doing? Oh, I'm not allowed to say that. You good? How are you? What's going on?
How many different ways can we say it?
Yeah. I just want to be like, how are you? What's going on? What's happening? What's happening?
Yeah, things are good. Things are in a slow season now where all client meetings are done, taxes are done. So now I'm getting back to studying again for the designation I signed up for in January. Because they emailed me and you're in the first class still. You have to take the exam by the end of May. Can you hurry up? I'm like, okay. So I take the exam in a couple days. Am I prepared? No, but does it affect my job? No. So I go into these things, I'm like, am I going to get fired if I don't pass this exam? No. So does it actually matter? No.
Well, it's kind of a waste of time then. Well, I guess you don't like the exams. That's right, because you don't want the continued education. You just want the knowledge.
I can't stand the exams, but the next course doesn't open up until you pass an exam.
Oh,
so I'm like, well, I have to pass the exam if I want the next content.
Oh, they're they got you, Dave. They gotcha.
They gatekeep everything. I'm like, okay, fine. All right, let's dive in. So we are talking about tax loss harvesting. The first thing you got to do is figure out, well, what is tax loss harvesting? So pretty much it's when you have an asset or an investment that has lost value. So if you paid $1,000 for it and it's now worth $750, you can sell it. You take that $250 loss and you use it for something different. Mostly if you're selling a position that has a gain, If it has a $250 gain, you sell both of them and now you have a zero tax consequence. Do you see it that way, Heather, or do you see it something different?
Tax loss harvesting.
Yeah.
I use it from a tax strategy standpoint, not really to sell other holdings, I would say, that are at gains. Mine is clients are in high tax brackets, or we have gains we really need to offset, like outsized gains in the year. And I want to offset them with capital losses. Yeah, it's complicated though. I mean, this year is, I'd say, the first year in a while where this has really been a thing in my firm.
Mm-hmm. Yeah, if the market doesn't go negative, you can't do this.
No, 2023 and 2024, not very much opportunity. And, for tax loss harvesting right now, this really became a thing in March, not for clients that invested in 2023 or even in 2022. It's for clients that recently added funds, right? Because if you added funds in January towards the top or December, then you have some tax loss harvesting opportunity. But if this has still been invested for a long time, like even the last few years, there's not as much opportunity. Because even when looking at the S&P right now, I just looked at it this morning, we're 8% up in the past year still. So it's only in that certain period of time in the last few months, if you added money, do you have a tax loss harvesting opportunity based on my models, right? This is different on different holdings, which we'll go through. But
yeah.
In my models in my firm, it's really only those clients that have been recently adding.
Yes. And it gets difficult with different types of investments. Like if you're using mutual funds, which use average cost as their cost basis, it's really difficult to tax loss harvest. But if you're using funds which are first in, first out, or if you're using another fund which is last in, first out, then you can cherry pick what you want to do and it becomes a little easier. So that's where choosing your investments comes in pretty important if you want to do tax loss harvests.
No, I literally have that situation. A client's, they listen to the podcast too, so they're going to hear this, but literally their legacy advisor brought over all these mutual funds, and I feel like I'm trading them in the dark. Like they might be at a loss yesterday because the price adjusts at end of trading day, right? So you sell during the day, you don't really know where it's going to land when it sells. So I have to make sure I have enough losses kind of brewed up that are realized in case the mutual fund swings by the time I sell it by end of day, right? Because you really don't know if it's going to sell for a loss or a gain. You kind of have to guess based on what the market is. But these are active mutual funds, so you don't really even have insight. This was another moment where I really started despising mutual funds, was during this period. I was like, nope, ETFs all the way going forward. I cannot, all my funds are models are ETFs, but it put another negative in the box hugely for me for mutual funds.
All right. So if you are trying to tax loss harvest by yourself, there's a strategy you can do. I sometimes do this for clients too. So let's say you don't want to get too out of whack with your portfolio, but you do want to tax loss harvest. So what you can do is you can sell the position that you are looking to tax loss harvest, and you can buy an investment that is similar. So it can be, okay, if you sell the S&P 500, you can't turn around and buy the S&P 500 again. And that gets hard. Like, because what if you say, okay, so I sold the S&P 500, can I buy the Dow Jones? Well, technically, they're both US large cap investments. So are they different enough where if you get audited, that's okay? The way to get around this, in my opinion, is if you are in a 70-30 portfolio, sell the position that you want the tax loss harvest for, buy a target date fund, which is a 70-30 allocation, so your allocation overall doesn't change too much, and you don't get into the, is it similar, is it not? And then when your waiting period is done, which is 30 days, then you sell that 70-30 position and you buy what you just sold. So there's the thing called the wash sale rule, which Heather's going to talk to us about because she's had experience with it.
Oh my gosh. You should see my spreadsheet tracking it for my clients. All right. So wash sale is that if you sell, let's just use Apple. If you sell Apple for a loss and then rebuy Apple within those 30 days, it is that loss is washed out, because the IRS is like, you basically just sold that position to take the loss and then buy it again. So you have to wait 30 days, and it's actually 30 days before or after you sold that position for a loss. So this gets like really technical, and it's not just within the account. So if you say, so some people are like, oh, I'll sell Apple at a loss in my brokerage account, but I'll go buy it in my IRA. No. It's over a household level. So it's amongst all your accounts. Now, Schwab, for example, does not track it amongst accounts. So, the chances of the IRS catching this are low, but if they do, you could not take that loss. You'd have to pay taxes back on it. And if you didn't listen to our RSU episode, that's a really interesting one too, because if you're selling at a loss of company stock in your company in your brokerage account for a loss, but you're about to have stock vest, be careful, watch sale rule.
Yeah, that's a big one. All right. So tax loss harvesting, when should you be doing it? So we talked about downturns in the market that allow you to do it. It's been rare to have that in the last couple of years, to have things go negative. It has happened this year in 2025. But like you said, just for recent money that's been invested.
I don't think it fits for every client, honestly. I have some clients that are in a pretty low tax bracket based on just situations right now, but I really believe that their career is going to grow and they're going to be in a higher tax bracket in a few more years, right? I don't really want to tax loss harvest for them right now. They're, of course, an asset accumulation, I should say, too. I think we should also say asset accumulation phase versus you're in financial freedom, retirement, different strategies with tax loss harvesting. So asset accumulation, if you're in a relatively low tax bracket, let's say 24% and below, I don't really prioritize that as much because you have to understand the tax loss harvesting, it's taking a loss now, but what are you doing in the long run? You're lowering cost basis. So at some point, when you go and sell that stock, you're going to now have a bigger capital gain. So you really have to look at the full picture. Now, my clients that are in 35, 37, sometimes even 32% tax bracket, okay, that's a pretty sizable amount of that I definitely want. Or if they have gains in the year, that we're going to be in a higher tax bracket because they sold in an investment property. We were diversifying out of their company stock for a while. Like this is going to keep them from, a huge net investment tax or something like that. It makes sense.
I think it's really helpful for people who are already living off their portfolio. Like if by living off their portfolio, they're generating gains as they go along by selling positions. If you can knock some of that tax bill out just by generating a loss, that's really helpful. When you have all gains, this strategy is really hard to come by unless you're doing something separate in another part of your portfolio. The part that I've seen, and people think about, okay, so it's just investment losses. And if I have an investment gain, then I can squash the two out and it's fine. Well, you kind of have to take a step back and say, well, how else can this help? So if you have an investment property that you want to, get rid of and you don't really want to have real estate anymore and it's got a gain, you can sell that, take the gain and figure out, okay, where can I find the investment losses in my portfolio? Because then it's still considered investment in a whole big bubble. You can wipe out the gain on your real estate if you're able to take the loss from your portfolio.
I literally did this with a client. I have a great example of this. They had the individual holdings, came over to me. I sold PayPal for a 6-figure loss. I was like, we got to get rid of this. Like, we all know I don't like individual stock picking, and sold it, and 6-figure capital loss. They would only be able to carry, really use 3,000 of that every year. But they call me and they're like, I really want to sell my investment property in Texas, but it has a 6-figure gain. Well, client, guess what? You're going to pay 0 taxes because I sold PayPal. So you let me win, now you win. So sell your investment portfolio. Win-win. Win-win chicken dinner. Is that what
it's funny because sometimes that works with, you get your agenda met and so do they. I had a client who they were working at Google and they got a lot of stock compensation, then they retired. So they essentially they held Google and they couldn't sell it because it had so much in gains, and their tax bracket was going to be, triggered if they started to sell it. And so we were just finding year on year, okay, where are the losses in your portfolio? I know you don't want to sell it, but we need to sell Google at the same time. So it's a trade-off. Like, do we want to get away from the risk of Google? We were able to sell all of their Google stock for a zero net tax bill because we were able to find those losses year on year. And so it then evened out their portfolio. And then it made sure that we could get their portfolio back to being diversified with a zero tax bill. And they loved it. It was a challenge to do it, quarter after quarter, trying to find those losses, but eventually it worked.
Do you know what else I've been using? You're going to laugh. But I've been actually using ChatGPT for tax loss harvesting. Compare this ticker to this ticker. Is this considered individual or identical? And it will tell me, instead of me going and looking up each of the funds and whatever, it will pull the data and basically tell me what the underlying index is, which then I can, first, of course, they give me their opinion, but I can think through, okay, that's a definitely different index, where I could argue to the IRS how this is not identical, right? But it is helping me be more fast, be more efficient in tax loss harvesting.
Nerdy tax loss harvesting strategy for business owners. And this is typically when they exit. So this is something I've actually been learning about in this curriculum I've been studying. It's if you sell your business and you have a large capital gain and you don't have any losses immediately to kind of counteract that, you can use a long short fund. So I'm going to get nerdy with it. I'm not going to explain it because I don't do it, but it's just a fun fact to go through. So use a long short fund. So you take, say you sold your business, you got 4 million in proceeds. You essentially split that in half. You invest some of it in the market, and then you short the market at the same time.
With margin. Is this where the 30, you do like 100 and then 30% margin?
Yeah, so it's a win-win. You either gain money from your investments growing, or if the money goes down, if the market goes down, the short fund essentially grows, which you can get losses from, or the market gets losses, and then that counteracts your tax bill. It's a fun strategy. I don't know if I'll ever get a chance to use it, but it's kind of cool when you can come up with these different strategies of what can I do to get away from this tax bill. One thing, in 2025, stock market was hella volatile. That's the headline. It's really hard to tax loss harvest when stocks or ETFs are really volatile. Like if they're swinging more than 2 to 3% in a day, which they have done this year, you can go in and sell something for a loss, and when that sale hits, your position has reversed and now you've sold it at a gain. So the way to get around this is limit orders. So you're essentially going in and you're saying, do not sell this position if it is above X. And if it's above that, then it doesn't sell. If it's below that, then it'll sell it at the price that it's at on the market. So this has caught me out. I hate it, but now when things are really volatile, I don't even try and do these trades.
Me neither. That's what I learned from this, because I think this, when the tariffs were happening, I was like, this isn't even worth it, because if I sell something at a loss to rebuy something not identical, so no wash sale, but if the stock market moves another 3% and I sold, let's just say something similar in large cap at -3, but now the market went back up 3, the loss in that time period of a large amount of money for a client, that 3% can be huge. Then you just kind of wiped out the tax benefit, right? So I completely just stopped. When I was saying that, I was like, nope, no trading today. I mean, buying is different. I think just buying is fine, but I would highly recommend to people doing this on their own to not tax loss harvest on volatile days.
Yeah, unless you're familiar with limit orders, like this is just going in with market orders and just pressing buy and sell. That you're running a risk there of not hitting the price that you want to get. All right, we are going into questions. This is called What Would You Do? All right, first question. I have a large amount of stock that was generated from RSUs vesting from my job. It's about 25% of my portfolio. If I sold it all today, I would have about $750,000 in proceeds, but $300,000 in long and short-term gains. What should I do?
Oh, this one's hard. This one is really difficult. First, it's going to depend on your risk tolerance. 25% of your portfolio, let's say you're not in financial freedom yet, so you're still working to really get to that financial freedom number. 25% of your portfolio being in one stock with your income tied to the company that 25% of your portfolio is too much risk right off the bat. We have to sell some this year no matter what. So I agree with them. How much is going to be really interesting based on their risk tolerance. I'd probably do a 50-50 approach. This is pretty high, right? Like 300,000 of gain. That's definitely going to jump some tax brackets if they're not already in 37%, let's say. Mm-hmm. I might do a 50-50 approach if they can handle it. And I'd also really be curious. I'd be talking to the client of, what do you feel about the company? How do you feel about if you lost 20% of this? Do you more want to pay the taxes and lock in this gain? Or are you more okay with writing it out and you're okay taking half of the risk off the table? This really needs to come up to a personal approach. I know you're probably like, just sell all of it, aren't you?
I'm not, because this is a multifaceted question.
Yeah.
Like, this is a tax question, risk tolerance, portfolio, investment design. This has so many layers to it. Like, if this was all in a 401k, I'd be like, sell it tomorrow. There's no tax consequence, and you've taken an excessive amount of risk. So you're in the bad here.
The other thing is, going back to tax loss harvesting, is looking at what else is in their portfolio that maybe we could sell to offset some of this gain if there is tax loss harvesting opportunity. This is a great example for our listeners of when you would tax loss harvest is you have a $300,000 gain. That is definitely a client that I'm really going to focus on seeing if I can find tax loss harvesting opportunities. I would like to harvest losses from some of my positions, but how do I go about this with a volatile market?
Carefully is how you're going to do this. We actually just mentioned it in some of our content. You're going to do it with limit orders. So if you're selling positions and those positions are moving a lot during the day, you're not going to be able to time this well with a market order. So a market order is when you hit submit on your trade and it goes through and it sells it, or whatever the market's going to be. A limit order, you can essentially say, do not sell it if the price is not X, or sell it if the price is X. If you're taking losses from your positions, where are the proceeds going?
That's my question.
So if you're having it sit in cash, that's fine. But if this is a two-pronged situation where you're buying something as well, you're actually probably going to have to do this a little slower if things are volatile. So you're going to have to do your sale first and figure out your proceeds, and then go ahead and buy, probably with another limit order, because things are going to jump and spike and drop during the day as well. So a little slower than calmer markets when you can just rely on a market order.
Or you wait till it's not as volatile, the market isn't moving as much, but you could risk not having a loss. Like, the market is, as we're recording this, has recovered some since our lowest in April, right? So tax loss harvesting opportunities were a lot bigger than like even a month ago today.
Question 3. My husband likes to stock pick, but he's terrible at it. We have 4 positions with over $100,000 in losses. Can we get any benefit from these loser positions?
Heck yeah, that's what tax loss harvesting is. Woo! But there is something I should mention, is that you can only carry over 3,000 of loss every year. So let's say you have no gains and all you are doing is selling $100,000 loss. You can take 3,000 every year against your ordinary income, which I think is awesome. It's not just against capital gains, against your ordinary income every year until you run through it. Now, if you're selling an investment property or you have some other holdings you want to sell in your portfolio at a gain, these can be used to offset it, which is pretty great.
All right, we are going into highlights. Highlights is our personal win section. You get to learn about us personally and what's going on in our life. Heather, you're going second because your story's way better than mine, just by this little note you have in our Google Doc. So mine is not as exciting, but we're done with searching for a house. We are over that game. Partly for the fact of the houses that we want are starting to get out of our price range because the inventory in our town is so low, and mortgage rates are not really budging. So that means it's more expensive than we want it to be. And these houses are barely hitting the market and they're going for over ask. And we're like, I don't like this market. This is not fun. So we're just going to stay in our house and do some projects here and put money in our pocket.
I remember that in Seattle when we were looking to buy a house. And I felt the same way. I was like, this isn't fun. I don't want to do this. And then, gosh, I didn't, because I ended up buying in Arizona, but for half the cost. But, Seattle, I remember that market. It is not fun to sell. But I do want to say, as your friend, it's not a now thing, but I hope you still do it when it's the right market, which, it's just a timing thing.
It is.
There will be. I hope you're not putting this forever off the table. I hope you revisit it when it's the right time, because I do want it for you.
It would be, we were talking about this, Sarah and I. We were like, it would be nice to have a house that is more finished. Not that we couldn't finish our house here with nicer stuff. But what are we giving up to do that? And we just weren't prepared to give up the stuff that was going to come with it. Or, tack on a bigger mortgage payment for 15 to 30 years. We didn't want that.
I've been there. That's why I'm about to go through a remodel. Yeah.
All right. Tell us your wonderful story.
All right. So I just got back from Italy. And it was just the most fabulous trip for multiple reasons. So one, Dave just learned this from me, but I made my first angel investment last year. I invested in a leather company named Plaid. And it is made from, it's really, really cool. It's made from plant waste. Going to Italy was to actually see the factory that this leather is going to be made. And I got to touch the leather, and I'm just beyond excited. It completely lights me up, if you can tell. And more importantly, I got to go with women that are also accredited investors. And Dave, I think you can understand this with me, but finding women friends that can also keep up with me with like business, strategy and talking about investments and stuff, that's been really hard for me to find.
Mm-hmm.
And I mean, these women are doing crazy, amazing things, right? They're all entrepreneurs, so they get me. And they're investing their money. One started a real estate fund. One is literally, she is literally for sustainable companies in fashion. She raises the money. That's her job. And so just to hear, it was just incredible to be around women that inspired me, right? It was the best. I really needed it. And so I'm definitely on a high right now.
That was a lot deeper than I thought you were going to go. Wow. I was like, I went to Italy, had some good wine, touched a belt, ate some great pizza.
No. It was definitely for a much bigger cost.
Well, if I need a belt, I know where I'm going.
Yeah, well, we're still in piloting phase, but yes, it's coming soon. And then I can't wait.
That's it. Thank you for listening to this episode of Playbook the Wealthy. You can find us on whichever platform you listen or watch podcasts. The video version of the show is on YouTube, Instagram, and LinkedIn. If you want to send us an email, you can. You can contact us at hello@playbookotw.com, and we'll see you next time.
Toodles.